technical analysis. Introduction to the module. To overcome the time and complexity constraints of fundamental analysis, currency traders frequently turn to a technical approach. Technical analysis makes a simple assumption. The price is a reflection of all market forces. One needs only to track the evolution of prices in any market to know whether the fundamentals, or the weights market participants attach to fundamentals, are changing. This module will introduce you to the tools and methods of forecasting using technical analysis. The fundamental principles of technical analysis. We have seen that fundamental analysis is devilishly complicated. Countless factors influence the demand and supply of currencies, each with varying weights and varying relationships to each other. The analysis can only indicate whether the conditions are favorable for the appearance of demand or supply, not whether it will appear. And it is specific to one market. A Euro or United States dollars trader, having completed a comprehensive analysis of US and UK fundamentals, must start all over again to be able to trade yen or euros. If one assumes that market participants who know or care about any economic development will act accordingly, the outcome of their purchases and sales will be the price. One can think of a financial marketplace as a pool of water. Any change in the economic, financial, or socio-political conditions is like a pebble that lands in the pool. It provokes ripples, very large at the point of impact, but diminishing as they move farther away. Those ripples are the price. The ripples reflect not only the size, weight, and contours of the pebble, but the water's characteristics too. Yet, there is a certain regularity about them. For example, small waves always follow large waves until they dissipate at the edge of the pond. Price. Technical analysis focuses primarily on the price. The price at any given time reflects all market forces, fundamental and human. Today's price movements resemble those of the past. Prices move in trends because market participants respond to fundamentals at different times. Trends continue until they are exhausted. The price means the same thing in all markets at all times. Volume and open interest. The term volume refers to the amount of currency traded within a period. On an exchange, the volume of securities traded is documented and published. In a decentralized market, like the forex market, volumes must be estimated. Banks and other online service providers typically track trading volumes on their platforms. Admittedly, no one platform can capture the entire market volume. What matters for technical analysis, though, is the relative volume, not the absolute. Was it higher in this period or the last? Are volumes rising or falling? Is the volume greater when the price rises or when it falls? Volumes can indicate market participants' awareness of a new condition. Open interest refers to the size of outstanding positions. These are positions that traders have entered but have not yet closed. Exchanges publish this information, but it is harder to come by in decentralized markets. Once again, though, online platforms do track the user's most popular trades. Increasing open interest indicates that new money is flowing into the market. Types of charts. Technical analysis uses price information displayed primarily in graphical form, price on the vertical axis and time on the horizontal. Time frequency is most often daily, but, depending on the perspective an analyst wants to take, it can be monthly, weekly, hourly or even minute to minute. These graphics are known as price charts. Line chart. The line chart is the simplest form of the price chart. It records a single price at the same moment in each period. A daily chart, for example, might capture the last quoted price of the session or the price at midday. bar chart. Each entry on a bar chart reflects the full range of prices traded during the period in a single vertical line, as well as the first price, opening price, and the last, closing price. The highest point of the vertical bar is the highest traded price or the highest bid of the period. The lowest point on the bar is the lowest traded price or the lowest offer of the period. A small horizontal mark to the left of the bar indicates the opening price. A small horizontal mark to the right of the bar indicates the closing price. The advantage of bar charts over simple line charts is that one can instantly recognize volatile days and regularly revisited price levels. Candlestick chart. A candlestick chart captures the same information as a bar chart, but displays it in a slightly different way. Instead of small horizontal marks to indicate the open and the close, candlestick charts represent the range between these two prices as a solid block, called a body. In periods where the close is higher than the open, up periods, the body is white or green. On periods where the close is lower than the open, down periods, the body is black or red. A vertical line continues to indicate the trading range of the entire period. However, this line now exits the body at the upper and lower end. It is to this wick-like feature that the candlestick chart owes its name.